Student loans. How will you ever be able to buy a house? Welcome, and thank you for joining. My name is Laura Key, and I'm also known as the Realty Goddess. So before we head into our discussion, a little housekeeping. Please make sure that you like, subscribe, and share. You will get valuable information on home ownership, and you just might get a giggle or two. So let's get on into it, okay? Got student loan debt. The government continues to toss forgiveness around like a bad volleyball game, and you're really working on trying to own a home. So how do these loans really affect you? First, in a time when the U.S. student loan debt grows 6 times faster than the country's economy, with over 43 million student borrowers in debt, with an average debt load of $39,351 each, it's crucial to understand how this debt spectrum affects key financial decisions like buying a home. A critical question that surrounds this financial issue is how student loan debt impacts one's ability to secure a home mortgage and get favorable interest rates. And let's face it, interest rates are not what they've been in the past, but they're also not the worst that we've ever seen. You got to remember, in the days of our parents, they were paying double digits. But contrary to some beliefs, student loan debt does not influence your chances of acquiring a mortgage any differently than any other type of liability. Now, a prospective lender would look at both credit card debt and student loan debt with equal scrutiny, as they are both commitments that require repayment. Now, the process involves assessing all of your current monthly payments and then judging whether you can handle a new one in the mix. If you qualify under the lender's lens, you are then considered for an interest rate. Yeah, that's the scary part, I know. However, having student loan debt can act as a double-edged sword. It doesn't automatically disqualify you from getting a mortgage, but depending on the severity of your debt, it might be. So the decision often boils down to your debt to income ratio. It's a vitality that's very important that many lenders analyze. Now, this ratio usually uses the sum of current debt payments, and this is included of your calculated mortgage divided by your gross monthly income, not take home, gross. The money you earn before any deductions and any taxes take place is your gross. Now, if this ratio exceeds 43%, you may find it challenging to get your home loan approved. Thus, an optimal ratio should be at or below the widely accepted 36% mark. Okay, I know that might be scary, but honestly, how many of you really looked at your income and your debt to ratio? Because it can be changed very easily. That Starbucks bill might be a little higher than you think. So you may want to really look into having a budget worksheet, which I do have one for you. So, but this gives us a glimmer of flexibility, and it exists amid the financial conundrum. One potential solution is to lower your debt to income ratio. If you have a federal student loan, might be a tweak to your student loan repayment plan. You can actually call them and ask them to help renegotiate your student loan. So if you are not paying it right now, you need to get on a payment plan or have some type of forgiveness there or some type of hold on that loan, but you need to be able to explain that to your lender, okay? So, doesn't put you out right now, all right? You just have to look at it and see what it looks like. Don't be afraid. Get your head out of the sand. That's what most people do. They just don't want to look at it. They think it's so bad that they don't want to look at it. Well, how will you know if you don't even look at it? So opting for a graduated or an extended payment plan may stretch out your repayment plan, but it can lead to lower monthly payments and potentially improve your debt to income ratio. Now, recently, a favorable change was made to FHA loans to assist homebuyers with student loan debt. Unlike the past, when FHA lenders had to calculate your monthly student loan payment at 1% of the outstanding balance. The monthly payment amount now aligns with the debtor's actual student loan payment, providing a more realistic view of your borrower's spending ability. So they're looking at something a little different than they did before. So it's to your benefit. Among these fiscal elements, it's essential to remember that your student loan debt could also affect your overall credit score. And that's a critical number in the eyes of a mortgage lender. Those with low credit scores can consider FHA loans, which may be available with a credit score as low as 500, assuming that you can afford a 10% down payment. To conclude, student loans don't directly determine your mortgage approval. They undeniably play a significant role in a various indirect consideration that lenders take into account. So it's crucial to manage your student loan debts wisely to keep your home buying dreams within reach. It's not impossible. So don't let it stop you from reaching your goals. I mean it when I say you might not be where you want to be right now, but it's a great starting point to get you to your goal line. So earlier I mentioned that I have a free tracker, a debt worksheet for you. If you are interested in that, please make sure you read I'm going through it right now. Please make sure you read the description below this video, and it will direct you to where you can download that free resource for you. So until next time, I wish you nothing but love, light, and blessings. Why not go out on a limb? Isn't that where the fruit is? Yes. Sugar. Bye, everybody.